Hello econ students, welcome to this video. In this video you're going to learn about taxation, government budgets and why governments spend money. It is continuation of fiscal policy that you learned earlier. If you want to check out the video on fiscal policy, please click on the link here. We will start by learning about budget. Every organization sets out plan how they're going to spend their money and get their revenues in the budget. Likewise, government also plans their expenditure and their revenues in their budget. Usually the budget is prepared by Ministry of Finance and it needs to be passed by the Parliament. Sometimes the government would have to review its budget and adjust its expenditure. Like during this COVID-19 situation right now, most governments around the world are having to review their budget and announce additional stimulus package because the COVID-19 situation around the world has impacted the economy and the businesses in a very negative way. And in order to help businesses continue and survive and keep jobs, governments are making additional spending and therefore they need to adjust their budgets. Over here we can see some examples of government budgets and changes in the budgets. For example, Spanish government has approved an austerity budget, including a tax rise for the rich and 8% spending cut. Austerity budget is a budget where the government is trying to cut their spending. Usually it would be some sort of contractionary fiscal policy. And over here you see Australia plans 3.8 billion US dollar budget surplus in 2 years. A government would have balanced budget when public expenditure is exactly equal to public revenues. However, that is not the case always. Government often incur budget deficits and that is the characteristics of many governments these days. Malaysian government also has a budget deficit, so does many governments, and especially during this COVID-19 situation as governments spending has increased, most economies around the world is facing increasing amount of budget deficit. Now, budget deficit occurs when public expenditure is far greater than tax revenue, when government spends more money than it gets. In this situation, the government would have a budget deficit. And a budget surplus is when public expenditure is less than tax revenue. In this situation, government would have excess money, surplus money, available to them after they have made all of their spending. An expansionary fiscal policy would increase a budget deficit or reduce a budget surplus. A contractionary fiscal policy, on the other hand, would reduce a budget deficit or increase budget surplus. If the government is running a budget deficit in the long run, it must borrow money in order to finance its deficit. That is, a government must borrow if public expenditure exceeds public revenue. The total amount of money borrowed by the public sector of a country is referred as national debt or public debt. Obviously, it makes sense that if anyone is spending more money than they're earning, they would have to get it from somewhere. And where do they get it from? They would have to borrow it. Similarly, government does the same. And if government borrows money to fund its current expenditure, in the future, it would have to be repaid. And if the government is borrowing, it means that it has to be paid by future taxpayers. So in one hand, if government is spending excessively today, it means the future taxpayers takes the burden of it. These graphs are showing US national debt from 1980 till 2017. And as you can see, US national debt is increasing over the years and it has tremendously increased over recent years. At the same time, the second graph is showing US debt as a proportion of US GDP, which means the future taxpayers in United States would have to repay this. So usually government borrowings are for long term, and that means the government's current expenditure is going to be financed by the next generation. And usually that's why governments like to have their debt reduced. However, many developed countries around the world have high debt. Over here, we can see countries with highest and lowest ratio of national debt to GDP as of 2016. Now you can see some of the countries with highest debt are countries like Japan with 234% debt. So their debt is more than twice the size of their economy. Similarly, Greece, Italy, and some of the countries with lowest national debt as proportion of their GDP are countries like Oman, Chile, Congo, Algeria, and so on. Now, you would notice something interesting here. Usually, some of the countries with highest national debt as proportion of their GDP are developed countries, rich countries like Japan, Greece, and you might be wondering why these rich countries have so much debt. Well, that's for you to find out. But obviously there are some countries like Eritrea, which has high, they are not very developed, yet they have high debt. And countries like Singapore also has quite high debt, 110%, which means the total debt is more than the size of the economy. Now, it is fine to have debt as long as you can afford to repay them. So countries like Singapore, yes, they have high debt, but their economy is also growing at a high rate. So probably they have taken these loans in order to finance the infrastructure development and that is fueling growth of the economy, and they're able to repay this debt easily. However, some of the low-income countries find difficulties in paying back their debt, and they spend most of the country's revenue in repaying the debt, and they have very little money left over to develop the country and provide services for its people. Despite this wide variation in government spending, most governments have similar objectives in regard to why they spend money. Governments spend money to provide goods and services that are socially and economically desirable, including public goods and merit goods. And merit goods are those that have high desirable effects, and if they are only left to the market system, they will be underprovided, things like healthcare and education. The government also spend money to invest in social and economic infrastructure, such as building roads, port, internet connectivity, and so on. Agriculture in many countries are considered to be key industry in order to ensure food security, and industries such as defense and other industries which are important for innovation is often funded by government. So for example, if you look at these days, many countries are spending a lot of money to fund research on COVID-19 and cure for COVID-19 and things like vaccines and etc. Government also spend money in order to reduce inequality in income between the rich and the poor. They do this by taxing the rich and helping out vulnerable groups, by providing welfare benefits, by providing things like education, healthcare, welfare, unemployment benefits, and so on. And all of these payments are called transfer payments because it transfers income from one income group to another income group. And also government spending is a key factor to manage macroeconomy. So for example, if the country is going through recession and experiencing high levels of unemployment, the government would increase their levels of public spending in order to achieve the macroeconomic objectives. Many private sector firms therefore benefit directly from different public expenditure or indirectly from their impact on total demand in a macroeconomy. For example, construction firms benefit from contracts to build roads and other publicly funded infrastructure. Similarly, office equipment manufacturers benefit from public spending on equipping government offices. Farms may benefit from agricultural subsidies to increase their production of food. Power companies may earn revenue from providing electricity for street lighting and providing electricity to government offices. The defense industry may benefit from order of defense equipments. Some firms may receive government grants and subsidies to fund new research and development, to buy new equipments and premise to train its employees. So government spending do benefit private firms in many ways. We have discussed why do governments spend money. Now we'll look into some of the reasons why government taxes. We will look into some of the reasons why government imposes tax. One of the key reasons why government imposes tax is to raise revenue to finance its expenditure. Taxes are used to manage macroeconomy. So, for example, government may cut taxes in order to boost employment and increase economic growth in times of recession in the economy. Government can reduce inequalities in income through taxes by taxing the high income group more and providing welfare services and reducing taxes for the low income group. In this way, the gap between the rich and the poor would reduce. And taxes can discourage consumption and production of harmful goods. For example, if we look at this example, America's soft drink industry battles proposal to tax sugary sodas. So government in many countries lately are imposing taxes on sugary drinks because they are considered harmful for health. And they want to discourage people from consuming the sugary drinks and switch to healthy alternatives. Similarly, taxes can be used to protect environment. For example, Singapore has introduced carbon tax. Carbon tax is basically tax on fuel. Their purpose is to reduce greenhouse gas emission because if fuel becomes more expensive, people would use more fuel efficient cars. Now we'll look into principle of taxation. What are the bases on which government taxes people? The proportion of tax that is taken from national economy is referred as tax burden. This bar chart is showing total taxation as percentage of GDP from different countries in 2017. So countries like Kuwait has low proportion of their GDP that is taken for taxation, and in countries like in Denmark, the level of taxation is more than half of country's GDP. Let's try to analyze this data. So countries with low taxes are Kuwait, Nigeria, Saudi Arabia, Qatar, and so on. Now, you might be wondering how come these countries have such low levels of taxation. Now, it is not surprising that primarily these countries are oil-rich countries, and due to their high oil revenue, the government can finance most of their expenditure from money that they get by selling fossil fuels, and therefore they don't have to tax their citizens and residents that much. However, if you look at countries like Denmark and France, these countries have strong social welfare system, such as there is free healthcare, free education, and pension schemes, and so on. And in order to fund this heavy social welfare programs, the government needs to tax its people. But then if you go and see countries like Indonesia, Pakistan, and India, they're not necessarily very rich countries, yet they have low tax collection. And that might be because most of the people in those countries have low income. As a result, they don't pay tax. And maybe there might be also other systemic reasons, for example, corruption, which discourage people from paying taxes and they can easily evade paying taxes and so on. Now let's discuss about tax evasion and tax avoidance. Taxes are compulsory payment backed by law. Non-payment of taxes and tax evasion is a punishable offense, and people could be jailed for not paying taxes. Can people avoid tax? Well, depends. Some tax can, however, be avoided legally. For example, if you want to avoid tax on car and petroleum, then you can choose not to own a car or drive. Taxes on cigarettes can be avoided by not smoking. So yes, you can avoid taxes legally, but again, if you're trying to avoid taxes illegally, then you might get into trouble, so better not do it. Similarly, wealthy individuals and multinationals avoid tax by moving their wealth to countries with low tax. We call these countries with low tax as tax haven. Is there anything as good tax? A good tax should be designed with certain principles in mind. One of these principles is equity. That is, taxes should be fair, and it should also look into individuals' ability to pay. So someone who has higher income is taxed higher, and that perfectly makes sense. Another important characteristic of good tax that it should be non-distortionary, and tax should not discourage normal, sensible economic behavior. So government should not raise taxes so high that people are discouraged to work. Because if taxes are too high, then people would think that what is the point of working harder and expanding a business when most of this increase in earning would be taken away by the government. Another characteristic of good tax is certainty. People and firms should know when a tax should be paid and how much they should pay. Tax should be relatively stable from year to year and should not be subject to sudden fluctuations. This allows people and firms to know broadly how much tax they need to pay in future, and they can accordingly plan their finances. Taxes should also be convenient to pay. It must be simple and easy for people and firms to pay the taxes they owe on regular basis. For example, income taxes are often collected by employers from every month's wages and salaries. People and firms can now pay their taxes online, and many countries are allowing their citizens to pay taxes using debit or credit card or electronic bank account transfers. Government would also need to receive taxes to pay for its recurring expenditure. Taxes should also be simple for people and firms to pay. It should not be too complicated that they get it wrong every time. So they should simply be able to calculate how much tax they need to pay, and this would encourage people to pay tax regularly and pay the right amount and not get into trouble. And taxes should be cheap to collect. If taxes are too expensive to collect, for example, the tax revenue is $10 million and government only receives $3 million, that means it's a highly inefficient tax. And there is no point in wasting resources and time in collecting such tax, and obviously tax reduces people's incentive to work. So such tax would be inefficient. Now we look into impact of taxation on economy. All the taxes in a country are together called tax system. Governments must decide whether they want a progressive, regressive, or proportional tax system. Each type of system will affect people and firms differently. In a progressive tax system, the proportion of income taken in tax rises as income increases. This means people or firms with higher income pay a higher proportion of their income in tax than those on lower incomes. Governments use progressive taxation because they feel those on higher incomes can afford to pay a larger proportion of their income in tax, and to reduce income inequality after tax, that is, to reduce the income gap between the rich and the poor. So this is an example of progressive tax here. As you see, the individual's income increases, they pay a higher proportion of their income as tax, and that is progressive tax. Such tax often includes things like examples of progressive tax are income tax, corporate tax, and usually the direct taxes. The next kind of tax system is regressive tax system, where proportion of income paid in tax falls as income rises. So which means the higher income group would be paying a lower proportion of their income as tax. As you can see here, as individual income is increasing from 5,000 to 20,000, the proportion of tax that they pay decreases. So the lower income group pays the highest proportion of tax, and the highest income group pays the lowest proportion of their income as tax. But again, don't be mistaken. It does not mean the rich pays lower amount in tax. The rich pays lower proportion of their income as tax. Usually indirect taxes such as GST, VAT, SST, they are regressive in nature because these taxes put higher burden on the low income group. And the next kind of tax system is proportional tax system. It takes the same proportion of income irrespective of income level. So that's the last category here. So all income group pays the same proportion of their income as tax. Now again, be mindful that these are proportion, not actual amounts. Now we'll look into types of taxes. There is direct tax and indirect tax. Direct tax is taken directly from individuals or firms' income or wealth. The burden of tax falls directly on the person or the firm responsible for paying it. Example of direct taxes are income tax, corporate tax, capital gain tax. Income tax is tax on wages and salaries. Corporate tax is tax on profits earned by businesses. Capital gain tax is, let's say, when someone is buying a property and they make a gain, is the tax on that gain. The next kind of tax is indirect tax. Indirect taxes are taken indirectly from income when they spend on goods and services. Examples of indirect tax are things like VAT, GST, sales tax, tariff and excess duties, and so on. Over here you can see the revenue, tax revenue in South Africa by its type. As you can see, personal income tax contributes around 36% of revenue in South Africa, and company income tax contributes about 18%. VAT contributes around 26% of the total revenue, and you can look at the other kinds of taxes here. Now we'll look into some of the statistics regarding government spending and government revenue. Over here we have a pie chart showing government spending in United Kingdom. The UK government is spending most of its budget on social protection, that is, on welfare payments such as unemployment benefits. Secondly, is spending around quarter of its budget on health, and around 23 billion pounds on education, which is a considerable amount of the total pie. Now let's look at the UK government's revenue. Where does it get its money from? This pie chart is showing revenue received by the UK government. As you can see, the biggest source of revenue in the UK is income taxes, more than quarter, and next is payroll taxes, and then corporate tax and VAT. VAT is sales tax, and this is an indirect tax. Income tax, payroll tax, corporate tax, these are direct taxes because they are directly taken from income or wealth. VAT, excess duties, these are indirect taxes because they are not directly paid by the taxpayer. Rather, they are paid by the taxpayer through the seller. So we pay GST or VAT when we buy something, and we pay it to the seller of that particular good or service, and then the seller forwards this receipt to the government, and hence they are called indirect. So if you are confused about what kind of tax is direct or indirect, you can simply just look at it from, point of view is whether the individual or the firm is paying this tax directly to the government, or they are paying through another party, that is the seller. If it is through seller, then it's indirect, and if they're directly paying for it, then it would be direct tax. Over here we can see the federal budget for 2016 in Malaysia, and you can see how Malaysian government in 2016 have spent their money and received their money. So most of the revenue in 2016 came from income taxes, and only 21.9 came through indirect taxes, which includes things like GST and other tariffs and so on. Tariffs are tax imposed on imported goods. I hope by the end of this video you understand more about taxation and government revenue, and how taxation and government spending affect our lives. Next time we will learn about another government policy that helps in achieving macroeconomic objectives, that is monetary policy. So thank you very much. See you next time.